Yeah, a lot of people are talking about this right now. I mean, the original story goes back to 1979, I guess, when Business Week magazine published a famous cover that said, "Is this the death of equities?" Because the equity markets have been performing quite badly in the States and globally for quite a long period of time. And people were starting to get, I guess, disenchanted with equities. They were starting to lose faith, lose belief in the value of investing in equities. So Business Week published this cover saying, "Is this the death of equities? Are people never going to invest in them again?" And of course, within about a year of that happening, we had one of the beginning of one of the strongest bull markets ever, the 1980 to 2000 bull market. So I think what's interesting is that people are starting to ask this question again now. Recently, we've had Bill Gross of PIMCO, who of course is the world's biggest bond manager. So, you know, quite why he's so interested in the death of equities. Maybe he's got a vested interest there. But, you know, he's been saying, you know, equities in this, what he's been calling new normal environment, equities maybe aren't going to be the best investment opportunity. And so he's again asking this question, is this the death of equities?
So he said the same thing.
He said the same thing, but kind of 20 years later. And I think, you know, the interesting, I guess the interesting answer to this is we don't believe that this is the death of equities. We don't think there's going to be such a thing as the death of equities unless some new way of investing in business comes along that replaces equities. And I think, you know, sometimes you have to step back and maybe look at the bigger picture. And if we look at equity investment, you know, it really came about maybe 300, 400 years ago. What happened was that merchants and ship owners in places like Holland and Britain were sending ships around the world, collecting cargo, coming back, selling it. And I guess there was quite a lot of risk. If you own one ship, then you've got to hope it doesn't get shipwrecked, it doesn't get mutinied, it comes back safe in one piece, and that it brings the right cargo to sell at the right time. So what happened was that groups of ship owners would get together and they'd form consortia. So they'd maybe spread their risk by taking 10% of everybody's ship, exactly, proportion of everybody's ship, rather than just being reliant on their own. And this proved very successful. It was, I guess it was the first real, you know, investment diversification. It proved very successful. And from that, we started to get the first companies that came about. The first real registered company was actually in Holland. I won't attempt to pronounce it, but it's known as OOC. And then we got these companies such as Merchant Taylor's Company in London, which represented particular guilds and business interests. And we also got geographical companies. We got the East India Company, and we got companies the Levant Company that invested in different in expeditions to different parts of the world to go and do trade there, bring it back, and sell it. And so this is where companies came about. Initially, it was really, as I say, business owners who were diversifying and spreading their risk and getting a return on their capital. And from that really developed into all the stock markets that we have today. And there've been lots of ups and downs along the way. Even back in the old days, there used to be bubbles and scams. And you know, the famous one was the South Sea bubble, where people invested in a company that didn't really exist and lost all their money. But despite all of this, equities have still, over 300 or 400 years, kind of evolved into being the best way, I think, for investors to use their capital, to get an interest in a business, to get a stake on the cash flow of a business, and to generate a return from doing that. I don't see any alternative. Nothing that's happened with all the financial engineering in the last few years has really created any kind of an alternative to equities for us. So I don't think equities are dead. I think the point is that there are parts of the cycle.
So you disagree with the Bill Gross?
I do. I think, I don't think equities are dead. I think equities are with us to stay unless somebody comes up with a cleverer way of being able to invest in a company and the cash flows of a business. Then I think equities are around for a long time to come. I think, you know, the question is always, is this a good time to be invested in equities or not? I think that's from a portfolio point of view, from an investor point of view. That's really the serious question here. And as you know, we've been saying for some time, this is still the winter cycle. This is still the time when it's actually, you know, cash, gold and bonds are the strategic investment to hold. But obviously, you know, we are moving through that winter cycle. And obviously one of the conversations we've been having lately is how close we are to the end of that winter cycle. We still think we're quite some distance from it, if not in terms of time, at least in terms of equity valuations. And our view is still that we're looking for this 30 to 40% fall in most equity markets before we think it's the time to buy equities. So I don't think equities are dead. I think maybe they're overpriced relative to where we are in the cycle. And when we see that correction come in, and when we see the economic conditions improve, that's really the time to be buying equities again. And at that point, maybe equities seem like they're a little bit sick at the moment. At that point, maybe that's when they get better and they recover.
Right.